Hi, this is Vijay Bambani here, and I hope the market's treating you well, you're keeping your finger on the pulse of the market, and you're making some good money in trading. In this video, I'm about to disappoint a few of my viewers, and I'm going to talk about something that is not exactly very mainstream view. It's a little off the beaten track, but then you guys know me for being a little different. You see, gauging from the feedback that I receive from my videos, as a behavioral market participant who goes by the 360-degree worldview, I get to have feedback from market participants. Believe me, everything is a tick or a cross on my mental spreadsheet. So whether you're talking positive or negative, your feedback is always welcome. It tells me something about the work that I'm doing and what the market participants are doing. Basically, it's no secret that we all talk about our positions. If we are long, we'd like to hear only good news. If we are short, we only want the market to go down. So basically, it's our positions talking. Also remember that as far as the systems go, this is not about boasting, this is not about antagonism, but this is about what I'm building up in this video. As far as the systems go, they have been right so far. The video that I recorded on 20th of July saying that the worst is behind us and you should be preparing to make profits was based on the seasonality of the markets, given a quarter by quarter breakup of what the market does in which quarter. Of course, a few guys misunderstood and said we expected a lot more from a so-called expert than the breakdown of seasons of the market. Since then, the Nifty has risen 6%, by the way. On 6th of June, I recorded a video about how to catch a market bottom based on the Cofox oscillator. Pure behavioral finance. Pure behavioral finance. Here again, while the reviews were largely good, a couple of viewers who basically did not get the formula right ran down the Cofox oscillator, and the market from 6th of June is up 16%. On 8th of May 2020, I recorded a video titled Market Situation is Not So Bad based on 4 data points. I was actually accused of selling my soul to the editors of Equity Master so as to entice subscribers to subscribe to services and make them go long. Incidentally, the market is up 26% from there on. So you know that the systems that I use are a little off the beaten track. Nothing personal against guys who send me negative comments. Please keep them coming. I thrive on your negativity also. I love you guys. But what are these offbeat systems that I use telling me now? That is more important. What is the outlook going forward? Are we in a market scenario where we should continue to ride the long and bullish wave, or should we do nothing, sit on our positions, or should we actually start short selling the market? Well, we are not in a situation where you should be selling the market. I'm at least clear on that. But this is a market where I would not like to do anything new. In 2007, I used to, in those days, write a weekly column for DNA Money and a daily column for Business Standard. And around August or September 2007, I wrote that the Nifty would peak out by 6375. It actually made a peak at 6357. I was off by 18 points, but I was approximately 5 months early. What did I do? I had learned lessons from the past. I have been trading this market since 1986. I had a good milk run till the dot-com bust in the year 2000. I was traveling abroad to celebrate my wedding anniversary. I had huge long positions and the markets nosedived after 16th March 2000. It's called the dot-com bust. I almost went bankrupt. The lesson that I learned from this hardship in life was that if you do nothing and if you pull your money out prematurely before a peak, you're still better off than the guy who's riding all the way down, listening to Buffettology. I have nothing against Warren Buffett or Peter Lynch's ideas. I'm coming to that later. I have nothing against these guys. But if these guys are going to ride the wave down, I would rather pull my money out maybe 5-10% earlier than the peak is made, let the markets bottom out, buy maybe 5 to 10% after the bottom is made, and thereby lose out a little on the top and lose out a little on the bottom. But net, I would not let my net worth go into minus. That itself will put me ahead of my contemporaries, my competitors, my cousin, my neighbor who I envy and who I want to surpass in life. I simply get ahead by not losing money before a market collapse. And what do markets do when they come down? Let me give you a lowdown. This is not the first time that the markets have given us the impression that this time it's different. The bull run is here to stay. Same voices, same talk, but nothing really changes. Let's take a look at the Bank Nifty. In January 2008, the Bank Nifty made a peak at 10,774, bottomed out in March 2009 at 3,314. It was supposed to be invincible. It only surrendered 71%. Only. Alright, the next time the Bank Nifty peaked out was in November 2010 at 13,303. It bottomed out in December 2011 at 7,766, thereby surrendering only 42% over a 1-year period. The next time the Bank Nifty peaked out was in January 2015 at 20,907 and bottomed out at 13,407 in February 2016, thereby surrendering 36%. Let's take a look at the Nifty 50, shall we? It peaked out, like I said, at 6,357 in January 2008, bottoming out at 2,252 in October 2008 itself, thereby surrendering 65%. November 2010, it peaked out at 6,338 and bottomed out only at 4,531 in December 2011, thereby surrendering 29%. In March 2015, the Nifty peaked at 9,119 and bottomed out in February 2016 at 6,825, thereby surrendering 25%. Now, before you think it's only 25% or 65%, do remember, many of these declines have spanned over a year. And when you go long in futures, you have to pay cost of carry or financing costs. So every time you roll over your long positions, not only are you paying mark to market, not only are you paying span margin, but you're also incurring finance costs. So your loss will actually be much bigger than 25 or 29 or 62%. It will be at least 10 to 12, if not 15% higher due to financing costs. Now that is what can hit you when you hold on for too long and you ride the wave down. It's very nice to hear, I'm not scared of the market. If you cannot bear a 20% decline the very next day after you buy stocks, you should not be in the stock market. I buy stocks and I don't look at them for 5 years. Fine, brave talk. Buy something and let it go down 5%. Believe me, you have to swallow your dinner hard. It doesn't go down the throat. It happens to me all the time. And just before you think that traders are not people who make money, and it's only the buy and hold Buffettologists who make big profits, let me remind you about the Robbins Cup Trading Championship, where people like Larry Williams, who I am honored to have met in person and have learned so much from, has taken 10,000 US dollars and converted it to $1 million in 1 year flat. He is the world champion winner of Robbins Cup. And it's no coincidence, he even trained his daughter, Michelle Williams, who's a Hollywood film actress, into winning this championship. So he's proved that these skills can also be taught. And it's not just the buy and hold guys who know about money. We traders also know about money. So when we are telling you, when a trader is telling you that this is a phase, you need not necessarily liquidate your portfolio. You need not liquidate and short sell at all, but it's probably not very wise to put in fresh money into the market. I'm sure there would be a couple of people who think I'm dampening their joy. As a matter of fact, Jason Zweig, a behavioral scientist, has written an excellent book called Your Money and Your Brain. He says he's interviewed a lot of game show participants, and whenever the anchor, think of KBC, Mr. Amitabh Bachchan guiding the participant by telling him or her, if you do not know the answer, you can quit while you're still ahead by XYZ amount. The participant at that point in time faces a storm of emotions inside. So when Jason Zweig interviewed a lot of these participants after the show was over and the emotions had died down, said more than 3/4 of the people he interviewed in the game shows felt a great sense of anger towards the anchor because they felt the anchor, by encouraging them to quit the show, was possibly denying them from being millionaires. One friend of mine actually encapsulated this sentiment very, very well by saying, Vijay, whenever I ask you for advice nowadays, you're telling me not to buy. Why are you keeping me away from me and my millions to be? So everybody is thinking of being a millionaire and caution is going out of the window. I'm not telling you to sell. All I'm telling you, hey, let's be careful out there. I'm not keeping you away from your millions to be either. But there are times when it is more sensible to not do nothing. Probably this is that time. On this cautious note, I'll say goodbye in this video till we meet again in my next. If you're watching this video on YouTube, don't forget to click like on this video if you agree with what you say or what you hear and see, and subscribe to my YouTube channel. In the comment section, do let me know what you think about this video and what you want me to record in my next. Your flaming, your trolling, and your negative feedback is also welcome. It helps me learn more about myself. Let me reach out to more people who are interested in a 360-degree worldview and a knowledge-based investment and trading regimen by recommending my video to your family and friends. Till we meet in my next video, do take very good care of yourself, your health, your family and friends, your trades and investments. Have a very profitable day. Thank you for watching.
Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.